Economics isn't just about numbers or charts, it's about understanding the world around you. As a young person, learning economics can empower you to make better financial decisions, understand how markets work, and prepare you for the real world. Whether you're managing your own money, considering a big purchase, or planning for your future career, economics gives you the tools to make informed choices. Think about it. Economics explains why prices go up, why jobs are created or lost, and how governments make decisions that affect your daily life. Understanding these concepts can help you navigate financial challenges and opportunities. It also helps you see the bigger picture, how your personal choices impact the economy and how the economy impacts you. By learning economics, you're investing in yourself. You're gaining skills that will help you no matter what path you take. So why wait? Start learning economics today. It's the key to making smarter decisions and understanding the forces shaping your future. Your future depends on it. Welcome to our exploration of a crucial aspect of the global economic framework: government regulation of markets. At its core, regulation ensures that markets operate fairly and efficiently. Imagine a world where businesses monopolize industries or prices become wildly unpredictable. Regulation steps in to prevent these detrimental scenarios. By overseeing mergers and pricing strategies, governments maintain a level playing field that encourages fair competition. This intervention isn't just about rules, it's about balancing scales to benefit both consumers and businesses. Regulation provides stability, preventing market failures that could have far-reaching economic impacts. As we embark on this journey, we'll demystify the foundational role of these regulations, highlighting their importance in fostering stable and equitable markets. Stay with us as we delve into the dynamics of government intervention and explore the mechanisms steering our economy toward fair and sustainable growth. Let's begin our exploration of government regulations with a fundamental tool: price controls, often imposed to make essential goods and services affordable. Price ceilings cap maximum prices, like rent controls aimed at making housing accessible. Conversely, price floors set a minimum price on goods, such as in agriculture, ensuring farmers can sustain a living. Antitrust laws are also crucial for maintaining competition. They prevent monopolies and promote market entry, safeguarding against unfair practices that stifle innovation and hike consumer prices. Lastly, environmental regulations are increasingly important. These laws protect our environment by controlling pollution and encouraging sustainable business practices, such as emission limits for factories or restrictions on resource extraction. Each form of regulation contributes uniquely to economic stability and a competitive marketplace. They balance economic efficiency with the greater good. Understanding these frameworks reveals their role in performing a delicate dance between market forces and public interest, shaping a robust economy for everyone. Examining these regulations provides insight into how they collectively aim to enhance fairness and sustainability within the economic landscape. To understand government regulation, it's essential to explore some key terms. Market regulation encompasses guidelines set by governments to oversee and influence market operations, ensuring stability and preventing monopolies. Antitrust laws focus on preventing unfair competition, promoting a level playing field among businesses to keep markets vibrant and consumers protected. Price controls allow governments to influence the cost of goods and services, either through ceilings or floors, often used to stabilize the economy during inflation or scarcity. Subsidies also play a vital role, offering financial support to industries deemed crucial for a nation's economy or strategic interests. Grasping these concepts provides clarity on how regulation impacts markets. This knowledge helps appreciate the balance between regulation and the free market, contributing to a fair and competitive economic landscape. These tools emphasize the intent behind regulatory frameworks, advocating for transparent and thriving markets. The 2008 financial crisis underscored the need for robust regulatory measures, leading to the Dodd-Frank Act, a landmark legislation reshaping the American financial landscape in 2010. This act addressed failures leading to the severe economic downturn by stabilizing the financial system, enhancing its resilience, and increasing transparency. It protected consumers from exploitative practices and averted future crises through stringent oversight of financial institutions. Central to its provisions was the Financial Stability Oversight Council, identifying risks to U.S. financial stability, and the Consumer Financial Protection Bureau, shielding consumers from harmful financial products. The Volcker Rule, another key component, limits banks from engaging in proprietary trading or owning hedge funds and private equity funds to curtail potentially harmful economic risks. While the Dodd-Frank Act has been vital in preventing financial turmoil and increasing accountability, it has critics. Some argue that the regulations have hampered economic growth by imposing heavy compliance costs, particularly on smaller institutions. Nevertheless, the Dodd-Frank Act remains a pivotal example of government intervention, illustrating the delicate balance between economic protection and fostering innovation. Reflecting on lessons from the 2008 crisis, regulatory roles are crucial for maintaining stable and fair financial systems. As we conclude our exploration of government regulation, it's evident that regulations play a vital role in promoting fair competition. By setting frameworks guiding market behavior, governments mitigate failures and protect consumers against unfair practices. Well-crafted regulations are the backbone of equitable market systems, fostering trust among participants, essential for a thriving economy. Yet we must recognize the complexities that accompany regulation. If too stringent, they can stifle innovation. The goal is balance. Regulations should protect public interests while allowing markets the flexibility for innovation and growth. Consider the Dodd-Frank Act. Born out of the 2008 financial crisis, it illustrates both the necessity and complexity of government intervention. While effective in fortifying the financial system, some criticize it for overly constraining smaller financial entities. This dual nature of regulation underscores why informed debate and continual assessment are crucial. As markets evolve, so must the laws governing them. Policymakers must balance safeguarding economic interests with nurturing the entrepreneurial spirit. Understanding regulation equips us to critically evaluate its implications. It's an ongoing dialogue shaping individual markets. Whether you're an aspiring economist, a seasoned business owner, or simply a curious learner, remember, regulation is as much about fostering potential as maintaining order. For more insights into the complex interplay of economics and policy, subscribe and join us on this educational journey. Together, we can unravel how economics shapes our world.
Welcome to our exploration of fiscal and monetary policies, the backbone of economic management. These crucial levers used by governments and central banks steer the economy. Imagine the economy as a complex machine, bustling with activity, connecting businesses, households, and entire markets. Fiscal policies involve adjusting government spending and taxes to influence economic activity. Monetary policies are managed by central banks, using tools like interest rates and money supply to ensure stability. Understanding these policies is vital. They dictate the rhythm of our financial ecosystem, from grocery costs to job stability. As we embark on this journey, we'll explore how these decisions ripple through households, businesses, and markets. Through insights and examples, we aim to demystify these forces that, though unseen, shape our world. Let's set the stage for a deeper understanding of how these policies impact our lives and drive economic growth. Fiscal and monetary policies are fundamental instruments for steering the economy. Let's define fiscal policy. It involves government resource allocation through spending and taxation to influence the economy. Think of it as setting the thermostat of economic temperature, adjusting it in times of economic heat or cold. Monetary policy, managed by central banks, regulates money supply and interest rates, acting as the economy's heartbeat. Both policies play crucial roles in managing inflation and unemployment. For instance, to combat inflation, governments might reduce spending, while central banks could raise interest rates. During high unemployment, they might reverse these actions to stimulate growth. These fiscal and monetary levers shape a stable economic environment. Understanding their definitions is the first step in grasping their broader impacts on daily life and markets. As we proceed, remember these are the core mechanisms driving our economic well-being. In our exploration, economic indicators like GDP and CPI are pivotal. Gross domestic product, GDP, reflects overall economic activity. Gauging economic health, the Consumer Price Index, CPI, tracks changes in consumer goods and services prices, offering insights into inflation trends. These indicators are essential for policymakers as they adjust strategies for economic growth, inflation, and employment. Understanding these metrics provides insights into economic performance and guides decision-making to sustain a stable, flourishing economy. Stay with us as we delve into how these indicators impact you directly. As we delve into fiscal and monetary impacts, we see how these policies touch our wallets. A tax increase means more money goes to the government, less for daily needs. Interest rate hikes make borrowing costlier, stretching monthly budgets. Suddenly, saving for a vacation or buying a new car seems daunting. These shifts impact everything from groceries to mortgages, altering financial landscapes. It's crucial to grasp how these policies operate. They're not just abstract concepts. They're integral to family finance, profoundly affecting spending and saving behaviors. Focusing on businesses, fiscal and monetary policies heavily influence operations. Policies can significantly alter business costs, shaping production and services. Changes in interest rates and tax laws affect investment decisions, expansion plans, and employment. Businesses must navigate these economic waves, balancing costs against growth potential. Understanding these dynamics equips them to plan and sustain themselves in a dynamic market. What tools help them address these policy impacts? Join us as we explore strategies for businesses to stay resilient and forward-looking amid these changes. The COVID-19 pandemic posed global challenges, highlighting fiscal and monetary policy's critical role in stabilization. As businesses closed and unemployment soared, governments acted swiftly. In the U.S., fiscal responses included stimulus checks, offering immediate relief to households. Meanwhile, the Federal Reserve reduced interest rates to spur economic activity, encouraging investment and spending. These coordinated efforts illustrate how policies mitigate crises and foster recovery. The pandemic serves as a study of these tools' power and importance during economic distress. Examining these actions provides insight into how these responses shape our economic environment and their indispensable role in daily life. Understanding these concepts is key to appreciating their influence on households and businesses. As we conclude our exploration, it's clear fiscal and monetary policies are more than abstract concepts. They actively shape our world. Decisions like altering interest rates or changing tax structures affect how we save, invest, and spend. We've seen households feel the effects and businesses adjust to stay resilient. Real-world examples, like the 2008 financial crisis and the pandemic, highlight the profound impact of these policies. Understanding them isn't just for economists, it's crucial for everyone, empowering informed decisions that can enhance financial well-being. We hope you now feel better equipped to engage with the economic world. Thank you for joining us. For deeper insights, like, subscribe, and stay tuned for our next video on central banks' role in controlling inflation. Until then, keep exploring and questioning the world around you.
Welcome to Understanding the National Economy Through Economic Data. Economic data forms the backbone of comprehensive economic analysis, illuminating the health and dynamics of a nation's economy. Throughout this video, we will uncover the significance of these vital data points in revealing economic trends and influencing major economic decisions. Ever wondered how economists predict recessions or booms? It starts here with the numbers that tell a nation's story. We'll explore key economic indicators like GDP, unemployment rates, and inflation, illustrating how they paint the economic landscape. By understanding these basics, you'll appreciate how economic data not only interprets current trends, but also forecasts future movements. Ready to embark on this analytical journey? Let's dive into the world of economic data and discover its foundational role in shaping our economy. Understanding these elements is crucial for anyone determined to decode the national economy's complex narrative. As we delve deeper, we focus on three pivotal indicators: GDP, the unemployment rate, and inflation. These aren't just numbers, they are the pulse points reflecting our nation's economic well-being. GDP, or gross domestic product, measures all goods and services produced within a country, offering a snapshot of economic productivity and trends, signaling expansion or contraction. The unemployment rate provides insights into the labor market's health, with high rates indicating challenges, while lower rates suggest thriving job conditions. Inflation reflects the rate at which prices increase, affecting purchasing power. Moderate inflation is normal, but high inflation can disrupt economic stability. Together, these indicators guide economists, policymakers, and investors in decisions about our economy's present and future. By understanding GDP, unemployment, and inflation dynamics, we assess economic health and anticipate shifts. In today's interconnected world, these indicators are more than statistics. They are tools shaping national policy and impacting individual livelihoods. Let's explore how terminology plays a crucial role in grasping economic analysis's subtleties. In this segment, we delve into essential economic terms that form our analysis backbone. First, GDP, or gross domestic product, represents a country's total economic output, indicating whether an economy is expanding or declining. The unemployment rate reflects labor market health, showing the proportion of those seeking work but unable to find it. A high rate suggests economic distress, while a low rate indicates more job opportunities. Finally, inflation measures how prices increase over time, directly impacting purchasing power. By understanding these terms, we appreciate their relevance to economic analysis. These definitions are tools not just for economists, but for anyone seeking to understand economic decision drivers. By defining these terms, we set the stage for examining real-world applications in upcoming segments. Reflecting on the 2008 financial crisis, we observe how economic data was crucial in navigating turbulent times. As mortgage markets collapsed and global trade plummeted, economic data guided us. Key indicators like GDP, unemployment rates, and inflation forecasts shaped government and financial bodies' responses globally. Consider this: as GDP plummeted, signaling a severe recession, governments scrambled to enact stimulus packages, adjusting fiscal policies with increased spending. Unemployment surged to alarming levels, highlighting the need for job creation. Meanwhile, inflation or deflation concerns led central banks to slash interest rates, boosting borrowing and spending. Economic data was the linchpin for recovery, aiding policymakers in informed decision-making amidst chaos. The crisis highlighted how economic data impacts real-world implications, affecting millions' livelihoods. It taught the power of being proactive rather than reactive, using data as a guide. In our next segment, we'll explore how fiscal and monetary policies evolve, reflecting lessons learned from such moments in history. Concluding our exploration into economic data, let's recap their essential role in understanding national economic health. Monitoring indicators like GDP, the unemployment rate, and inflation empowers interpretation of trends, anticipation of changes, and crafting of policies aligned with stability and growth goals. The 2008 financial crisis showcased economic data's power in steering recovery and effective policy decisions. It illustrates the critical importance of data interpretation. In an evolving global landscape, vigilance and adaptability are key. Our journey in economics doesn't end here. In our next video, we'll dive into fiscal and monetary policies, exploring these strategies' influence on the economic environment and societal outcomes. If intrigued by economic concepts unfolding in real-world scenarios, stay tuned. We aim to provide content that educates and equips you with essential analytical tools for informed decision-making. Thank you for joining this journey. Subscribe to our channel and enable notifications to not miss upcoming videos. Understanding economics empowers comprehension of forces shaping daily lives. Let's continue exploring economic phenomena influencing our world. Stay informed and see you in the next episode.
Welcome to our exploration of market economy institutions. In this journey, we explore how various entities are fundamental in providing a stable and flourishing economic environment. A market economy thrives through the interplay of key institutions, each playing a unique role in its function and stability. From financial entities like banks and credit unions to legal bodies, government, labor, and educational bodies, each is indispensable for sustaining economic health. International entities and NGOs further enrich the ecosystem, promoting global trade and sustainable development. As we delve deeper, you'll gain a comprehensive understanding of how these institutions work harmoniously to drive progress and prosperity. Let's get started. In the intricate tapestry of a market economy, financial institutions are its backbone, offering essential capital for business ventures. Banks, credit unions, and others provide necessary funding for businesses to innovate, expand, and thrive. Beyond just funding, they manage money supply and oversee interest rates, crucial for economic stability. Imagine an economy where businesses can't access loans or citizens can't secure savings accounts. Chaos would ensue. Financial institutions act as unseen hands, precisely guiding economic activity and ensuring growth and stability. In times of economic turbulence, they often adopt strategies to cushion impacts, highlighting their importance. By funding current needs and investing in future realities, they are indispensable to the market economy. Let us now explore how government institutions complement these efforts. Government and regulatory bodies are paramount custodians of fair and equitable marketplaces. Every thriving economy depends on a structured environment, where competition flourishes and consumers feel protected. Through regulations and policies, these entities guide market activities, balancing efficiency with fairness. They set standards to ensure businesses adhere to rules, fostering innovation without compromising ethics. Moreover, by enforcing consumer protection laws, they guard against malpractice and build trust. From overseeing financial markets to ensuring truthful advertising, their role is crucial. They also mediate market conflicts, balancing private ambition with public welfare. By navigating these responsibilities, government entities create a stable environment conducive to economic prosperity. In essence, they act as both referee and protector, ensuring commerce proceeds with integrity, benefiting everyone involved. Understanding their contribution is imperative for grasping the market economy's complexities. In any thriving market economy, legal institutions ensure that the rules are clear and consistently upheld. They form the backbone of reliable engagement. They enforce contracts and protect property rights, establishing trust. Imagine a marketplace where contracts are mere suggestions. Chaos and stagnation would follow. Legal institutions mitigate such risks, making it feasible for individuals and companies to engage with confidence. Protecting these rights lays the groundwork for innovation and investment. They empower entrepreneurs to cultivate new ideas. As we navigate the network of market economy institutions, the dedication of legal bodies to fairness and order remains indispensable. Their role transcends simply encouraging participation. It's about fostering a landscape where economic possibilities are boundless. Next, let's explore how labor institutions shape the workforce landscape. Labor institutions are critical in safeguarding employee well-being within a market economy. Organizations like labor unions serve as guardians. They ensure fair treatment for workers, They tirelessly advocate for fair wages and enforce non-discriminatory practices, prioritizing safety. They create hazard-free workplaces across industries. Empowered by labor laws and collective bargaining, they address grievances efficiently. Fostering mutual respect between employers and employees enhances job satisfaction and productivity. This strengthens the market economy. Through continuous dialogue and negotiation, labor institutions reflect workplace realities, striving for improvement and adaptation. They remind us that a successful market economy hinges on respect for those fueling it. We will explore next how educational institutions prepare the skilled workforce vital for economic advancement. Educational institutions form the foundation of a skilled workforce, acting as a springboard that equips individuals. They provide essential skills and knowledge for a competitive economy. Besides teaching traditional subjects, they cultivate critical thinking. Problem solving and a spirit of inquiry are also emphasized. As factories of future talent, they foster an environment where learners become innovators. By promoting continuous learning, they keep the workforce agile for emerging challenges. Dynamic curricula encourage innovation, driving personal and societal advancement, from engineering groundbreaking technology to shaping policies. Educational institutions are linked to a nation's competitiveness and inventive prowess. In a marketplace valuing knowledge and skills, these institutions uplift economies and promote forward-thinking ideologies. They are the educational heart, from which the robust economy's lifeblood flows. In today's interconnected world, international institutions and NGOs shape the global economy dynamically. They facilitate cross-border trade, ensuring smooth goods and services flow between nations. By setting international standards and resolving trade disputes, they promote stability in the global marketplace. Meanwhile, NGOs advocate for sustainable development, addressing environmental concerns, social equity, and inclusiveness. Pushing for long-term global well-being, these institutions ensure global trade benefits are shared equitably, bridging economies and forming partnerships to tackle pressing challenges like climate change and poverty. Their influence transcends economic benefits, fostering global citizenship and cooperation. By understanding their roles, we appreciate the dynamics that drive interconnected economies and the efforts toward a sustainable future. Their guidance remains vital in navigating the evolving landscape of global trade. As we conclude our exploration of institutions' roles in a market economy, it's evident each is a cornerstone. Financial institutions, with their capital provision, serve as the economic backbone. Government bodies regulate and protect, ensuring fairness. Legal institutions uphold trust by enforcing contracts and safeguarding rights. Labor institutions ensure fairness, while educational bodies provide innovation by equipping a skilled workforce. International institutions and NGOs promote sustainability in global trade. Together, these elements uphold economic health. We encourage you to continue your learning journey, question more, and understand how each institution complements the other. If you found this insightful, like, subscribe, and join us for future topics, including technological change and globalization.